So today's video is going to take on the secretive world of hedge funds. Now, we'll take a quick look at what a hedge fund is. We'll do a very quick tour at a sort of beginner's level of, let's say, 4 basic strategies that hedge funds adopt. And at the end, we'll ask the question that a lot of people are asking right now: are hedge funds a good or a bad thing? Okay, so what are hedge funds? Now, one of the frustrating things about hedge funds is if you try and look up a legal definition on the internet or anywhere else you like, you won't find one. Okay? Hedge funds can be traced back to the 1940s, but most people probably didn't hear of much in the world of hedge funds until George Soros famously bet against the pound in the early 90s, all right, and made quite a bit of money doing it. That's probably the first time a lot of people have heard of hedge funds. Up till that point, they've been quietly operating in the background as kind of marginal part of the market. And now, in recent years, they've mushroomed and got a lot bigger. Okay, so there are a lot of hedge funds around, thousands of them around. Some are listed on exchanges, most aren't. So let's take a look at this world of hedge funds and answer those 3 basic questions. So one of the problems is that there's no definition of a hedge fund, and this is one of the frustrating things about them. It's quite difficult to say, well, this is categorically what a hedge fund does. Okay, it's almost easier to carry on and talk about what features hedge funds have rather than be categorical about what they actually are. So let's look at some key features. What would make something a hedge fund as opposed to a kind of bog standard, plain vanilla mutual fund or unit trust in the UK? What makes them different? Okay, a few pointers. Number 1, they tend to be quite secretive, right? They tend to be privately owned and privately managed. You're talking about some of the sort of so-called or supposedly best traders at the investment banks peeling off to set up a little privately owned fund that will be funded by private capital often. So it's basically private investors investing in a fund or institutional money investing in a fund that claims to have a strategy that no one else has thought of. All right, a lot of them claim to have first mover advantage. So naturally, they're quite cagey about what those strategies are. Okay, for example, now he wasn't a hedge fund manager, or he isn't now, but a friend of mine spotted a few years back that there is a timing delay when you watch a live match on Sky. Okay, it was around 6-7 seconds. So sneaky devil, what he used to do was get live Spanish football on the radio, real time, place a little spread bet before the outcome of, say, a free kick was known to most of the other people watching the same match on Sky TV. And he made money because he knew that the goal would be scored, if you see what I mean. And that's because he had a 6 or 7 second head start on lots of other people. Now that is a kind of sneaky little strategy that a hedge fund would call something like a football arbitrage strategy. All right, and obviously you don't want to tell people about it, because as soon as you tell people about it, either you get shut down, all right, so the spread betting firms change the rules or something, or so many other people try and do it, the opportunity vanishes. Right, so by definition, some of the ways that hedge funds make money are not publicised, because if they were, everyone would do it. That said, some of the strategies they follow are not quite as sexy and secretive as they might first sound. And in a moment, we'll look at 3 or 4 of the big ones. Okay, so secrecy, because they're privately owned, right? And often they're offshore, as it's called. They're unregulated. Not all of them. Now, unregulated doesn't mean illegal. All right, if you're illegal, you get shut down. Unregulated just means that maybe you're based in Gibraltar or in Jersey or Guernsey, for example, so you get some regulatory concessions in terms of how much information you have to give away to the markets and to regulators in, say, the UK. All right, so secretive, privately owned, following strategies that aren't always well publicised, unregulated, can be fairly illiquid, all right, can be quite difficult to get your money out of a hedge fund quickly. It wouldn't be if you own units in a standard mutual fund or unit trust, because you could just sell them, okay? But hedge funds often try and lock in their investors, all right, and that can mean when there's a bolt for the door, there's a problem, all right, because it's not always possible to just liquidate your holding immediately. And other features, they have a flexible mandate. Okay, in other words, they can do some things that standard regulated funds can't. They can play with derivatives, for example, to a greater extent, and we'll look at 1 or 2 examples in just a moment. Okay, that's not to say that most hedge funds are all out making crazy bets using derivatives, but they have the ability to use derivatives where other safer, more regulated, bulk standard funds wouldn't be able to. 2 other features that tend to grab the headlines. Number 1, a standard fund or fund manager will say, well, I'm doing a good job because I'm in the top quartile of my peers. All right, so if you take all the funds in my sector and rank them, I'm in the top 25%. Right. Okay. Now, hedge funds often make a different claim. What they claim to do is generate an absolute return. So they'll say, no matter what the markets do, we'll give you a certain return over what you could have got on cash or money market deposits, for example. In other words, they're setting an absolute target rather than what you might call a sort of relative target, you know, to be in the top 25% of funds like us. Okay, and that promise of absolute returns, quite a few of them, in fact, haven't managed to deliver on. But nonetheless, a lot of them set out their stall and say, well, the great thing about us is we can use derivatives, we can take short positions as well as long positions, bound falling as well as rising prices, hedge our position, protect our positions, and that enables us to offer an absolute level of return, come thick or thin. Okay, and that was used to market some of these funds in the early days. And finally, of course, the other headline grabbing feature of hedge funds before we move on to the strategies, high fees. High fees, right? You might have heard of the 2 and 20 structure. Right? The 2 and 20 is a structure where the hedge fund manager takes out 2% as a kind of standard annual management fee. Now, a lot of other funds do that, so a unit trust might take out 1.5 or 2% a year as a management fee. And on top of that, the 20 is the hedge fund might take out 20% of any profit that it makes, and that goes into the pocket of the hedge fund manager. So that's a fairly hefty old fee structure, so naturally they've got to be providing some pretty decent returns for their investors to kind of buy that fee structure. Okay, so there you have it. There's no legal definition of hedge funds. If you want one, I can't provide it, neither can anyone else. Okay, we'll look at some strategies in just a moment. But key features, secretive about what they do in some cases, privately owned, can be illiquid, unregulated or more lightly regulated than more mainstream funds. Okay, flexible mandates to include the use of derivatives, high fees, and the promise of absolute returns. So almost that gives you a kind of toolkit, okay, features if you're putting a hedge fund together. Now, what are the strategies that they claim to adopt to make the money that justifies the 2 and 20 fees? Right, the 20% performance fee, how are they going to justify that? Well, there are many, many, many different hedge fund strategies, okay, but I'm going to break them down into just 4, okay, and talk a little bit about what those 4 main strategies are. So I'm going to call them long, short, sometimes equity, long, short, okay. I'm going to call strategy number 2 relative value. That's quite often where a lot of the arbitrage stuff goes on. All right, I'm going to call number 3 event-driven. These are sort of groups of strategies, and I'll explain each one in just a moment. And I'm going to call number 4 macro. All right, so 1, 2, 3, 4. Now, straight away, people who know a little bit about hedge funds will be screaming at me, there's more than 4, there's 14, there's 20, there's 150, all right? True, all right? If you think that every single hedge fund only follows one of 4 strategies, you're mistaken, but the strategies can be grouped, roughly speaking, into 4 headings. So in an introductory video, let's go through roughly what that means. Now, if you come across a fund claiming to be a 1-30-30 fund, what does that mean? That's a bit of jargon that's used around the place in the context of hedge funds and sometimes more mainstream mutual funds. What it means is the fund manager's pulled off a rather neat trick. Okay, what he's done is to take, let's say, $100 and invest it in buying, that's going long, shares, for argument's sake. Well, that sounds like a normal fund manager so far, so what? All right. Then what they've done is they have placed short bets. Now, I've done a video on short selling, which you can take a look at if you want separately to this one. They've basically placed down bets on other stocks. They've shorted them. And if you make a short sale, you receive cash. Because what you're doing is you're selling stock you plan to buy back, hoping the price is going to fall. When you make the initial sale, you get cash. So imagine you take $100, stick that into the stock market, short sell, okay, $30 worth of stock. That generates $30 you can reinvest on the long side of the strategy. Quite cunning. What it means is you can invest a total of $160 per $100 received. So you can leverage up the fund, all right? And that's one feature of equity long short. Now, which is the more dangerous strategy? Buy and hold on the long side or short selling, betting on falling prices? The answer is short selling is riskier. The people who do it are taking more risk because if you get it wrong and prices rise, they can, in theory, rise to infinity. Right, so you can actually lose a lot of money very quickly on the short side. So this is the riskier bit. So hedge funds may claim to be equity long short, but it may be that only a little bit of what they're doing is short selling activity, betting on falling prices, whereas a more conventional fund manager would tend to be limited in terms of the amount of derivatives they could use and would have more of a kind of what we call a long only strategy. Okay. Another observation coming up on that type of fund at the end. Relative value, arbitrage, right? In a nutshell, that is identifying an opportunity to sell something that's expensive and buy something that's cheap. All right, now there are countless examples, and this is an introductory video. I'll give you an example of what could be a relative value arbitrage strategy. Sounds very grand. It sounds like that would justify lots of fees for me. So hedge fund managers do tend to use quite grand sounding terms. Okay, what would I do? Maybe I've spotted the relationship between two retail stocks. Okay, in terms of the share price relationship is 2 for 1. So if you like, one company normally trades on a graph at twice the price of the other. But something's happened today. That gap has narrowed. All right, so maybe the prices have come up to 1 for 1. I'm thinking that's unusual. That's unusual because normally the relationship is the first company has a stock which is twice the price of the second one. So maybe that normal relationship, I think, will be restored. Okay, so what I would tend to do is set up a pair of trades to exploit the fact I expect that 2 for 1 relationship to be restored. All right, and how would that work? While I'd, if you like, buy the stock I thought was cheap and short the stock I thought was expensive. That's a very crude example of a relative value arbitrage strategy. Okay. Event-driven, in here you have the vulture funds, the distressed debt funds, okay, the sort of bad guys of finance. This includes mergers and the events are corporate events, mergers and acquisitions, takeovers, companies in bankruptcy or near to bankruptcy. The vulture funds are the funds that go when no one else fears to tread. Right? They will buy up debt in seriously distressed companies on the brink of bankruptcy and gamble that they'll get out of there, restructure, and there's a profit to be made if they do. Okay? Or mergers and acquisitions arbitrage again. That's where you sort of think, well, okay, what's going to happen if one company takes over another? What's going to happen is the target will get a boost in its share price. And because predators typically overpay, it's known, studies have shown, people always pay, they get carried away with takeovers, they get excited, they compete with each other, they pay too much to the target, so the predator will end up overpaying. So what an M&A strategy might do, very, very simple one of course, would be say, well, I'll buy the predator and sell, sorry, beg your pardon, buy the target and sell the predator. All right, so to take advantage of the fact that one share will get a boost and the other potentially will suffer when people realise that the predator's overpaid. So you've got sort of event-driven strategies around M&A, bankruptcy, insolvency and so on, and they're macro. That's a very broad term. Macro funds take big bets, and I mean seriously big. I'll give you a couple of examples in a moment, on currencies. I think back to the early 1990s and the massive bets that George Soros made with his fund against sterling, okay? Or you've got the Amaranth fund that went basically bust in 2006, effectively placing a $6.6 billion US bad bet on natural gas prices. All right. Now, if you're thinking, isn't it a little bit grand to call this a macro-driven fund strategy? Yeah, you can call it punting on commodities if you want, but you know that's not grand enough title for your kind of long-suffering investors. All right. So you have to come up with a sexier name. But yeah, basically in 2006, Amaranth made a huge bet on natural gas prices. That would put it in the kind of macro style of funds. It went horribly, horribly wrong. The fund went out of existence. Now, of course, another fund called Centaurus made the opposite bet on natural gas prices and cleaned up. Well, that's the nature of being a hedge fund. It's risky. Okay, so I've given you a flavour for 4 strategies: equity long short, relative value arbitrage, event driven and macro. Very, very brief introduction, and please do not think, well, that's great, every time I buy a hedge fund from now on or think about a hedge fund, it'll only be following one of 4 strategies, because there are several different variants of each type of strategy. And I say funds are free in the hedge fund world to follow quite a range of different strategies that a conventional fund couldn't. Okay, final part of the video. Good or bad? Hedge funds get a lot of press. Okay, number 1. How much would I invest in a hedge fund as a private investor? Not too much. Hedge funds, for me, as a private retail investor, you can buy them. There are some listed hedge funds out there that are actually listed on the London Stock Exchange, but I would not put more than around 5, possibly 10% maximum into what I call the alternatives. All right? Hedge funds are not mainstream investments for most investors. Okay, so you can invest in them, and yeah, they might add a little bit of spice to your portfolio, but keep the percentage relatively low. Okay, now comments about hedge funds at the moment. Quite a few of them going out of business, some of them closing down. What does that tell you? In fact, a lot of hedge funds are closing down as markets generally struggle. So, as commodity prices come off the boil, the fact that funds are closing down tells you something about them. Maybe their strategies are not as sexy as they make out. Maybe a lot of them are just really long-only funds in disguise, the disguise being that 20% performance fee, and the truth of the matter is what they're doing isn't that clever. Okay, they're simply betting on markets rising, basically. It's just that they do it much more expensively than a conventional fund. Why would you pay a hedge fund manager to do that? Good question. And a lot of investors, I think, are asking that question at the moment. If this hedge fund is essentially long only, why am I paying a 20% performance fee for that? Okay. Now, are they a bad thing? Not necessarily. They're certainly not as bad as some of the trading desks at the big investment banks. Okay, because at the end of the day, most hedge funds are privately owned and they lose money for private investors who should know better than invest in them. Right? I don't have a problem with that. What I do have a problem with is investment banks getting themselves into trouble and then demanding taxpayer cash to get them out of trouble. Okay? I mean, in fairness to hedge funds, there haven't been any big hedge fund bailouts. That Amaranth fund I mentioned that went bust making natural gas bets, that wasn't bailed out by the UK or American taxpayer. It was just allowed to fold. All right? And I would say that's something that actually distinguishes hedge funds positively from some of the same people who are still working on the trading desk at the investment banks. All right? Because that's often where these hedge fund traders start out. All right? And those investment banks may go cap in hand to the taxpayer as part of a bigger banking organisation making similar bets to hedge funds, but with that kind of taxpayer guarantee, and that I do have a problem with. All right, so in summary, let's wind up on hedge funds here. There's no legal definition, and you're not going to go away from this video with one, but I've given you some key features. It's more about the sorts of ways they look and the features of hedge funds that distinguishes them from more mainstream funds. Number two, there are many, many strategies they follow. Some are not as sexy perhaps as the literature would have you believe, and I've given you 4 examples of big strategy groups, if you like. And thirdly, as to whether hedge funds are a good or bad thing, by all means, have a little bit of exposure in your portfolio to hedge funds. It is possible to do it through 1 or 2 of the listed funds, okay, but I'd keep that exposure down. Don't see that as a kind of mainstream part of your portfolio. And at the very least, you can say, well, if a hedge fund collapses, the only people who get hurt are the people working for it and the people who invested directly in it. Okay, so far, it's not been the taxpayer. And as far as that goes, I would say that makes hedge funds, frankly, better than some of the other aggressive traders in the market who have expected the taxpayer to bail them out when they've got into trouble.